If a statue was ever erected to honor the person who has done the most for American investors, the hands-down choice should be Jack Bogle. That's what Buffett wrote in his 2016 annual letter to investors. For a legendary person like Buffett to make that statement really tells you something about the founder of Vanguard, John Bogle, sometimes referred to as Jack. Since he's had such a positive influence on everyone watching this, as well as myself, I want to share with you his 10 rules for investing success. Now here's the thing, before I share each of these with you, there's something that everyone should know about him so you understand why he's both adored and disliked within the investing community. He's one of those people who put his money where his mouth was. When he said that he cared about making sure average investors like us weren't getting ripped off, he meant it. And oh my gosh, did it cost him a lot of money. Before I tell you how much, you have to understand how. You see, Jack structured Vanguard in a very unique way to where, unlike many other entrepreneurs, he didn't own a majority stake in the company. Instead, to align incentives in favor of the average investor, he decided that the people who invested in Vanguard funds should be the owners, not him. So if you invest in Vanguard funds right now or at any point in the future, then you are technically an owner of the company. When a company normally earns a profit, it's paid out to its shareholders. But instead of paying us out by writing us a check, we're rewarded through Vanguard lowering fees whenever possible. To try to compete with Vanguard, other fund companies like Fidelity, BlackRock, and Charles Schwab have been forced to lower the fees charged within their funds, which I am sure they're not too thrilled about. Think about that for a second. If Jack Bogle never did this, then I can guarantee you that all of these for-profit companies would be charging us an ungodly amount of money in fees, and there would be nothing that we could do about it. It's been estimated that Vanguard has saved investors as a whole $1 trillion in fees. But the real numbers are probably higher than that when we account for those people being able to invest those savings, which would earn a return. So how much did this decision cost Jack Bogle personally? Since he was so hyper-focused on saving the average person money, he passed away with a net worth of only about $80 million. While I think we can all agree that this is a lot of money, you have to understand it in the context of the net worth for his peers within the industry. Larry Fink of BlackRock, $1.2 billion. Steven Schwartzman of Blackstone, $12 billion. And Abigail Johnson of Fidelity, which is smaller than Vanguard, $12 billion. The title of this article sums him up perfectly. He should be a billionaire, but Jack Bogle chose to make others richer. So as I go through his 10 rules for investing success, remember that these are all based on his 89 years of experience and in the best interest of us as investors. The concept of reversion to the mean refers to the tendency of stock market prices to return to their historical average or trend over time, even though they might be up or down in the short term. His advice serves a few practical purposes for us. First, it warns us against chasing after high-performing funds based on recent returns. I see this all the time nowadays where people invest based on past performance when they're supposed to be investing for the future. Second, it encourages us to anticipate and accept fluctuations in performance as a part of the natural course of investing, which helps us avoid knee-jerk reactions to the short-term volatility. This is easier said than done because when the stock market takes a nosedive and you see your portfolio losing money on paper, it feels like the end of the world. And on the other hand, when the market has seen significant growth for a few years, it's easy to assume that it will continue indefinitely. Grasping the idea of reversion to the mean is really important for setting realistic expectations. It's like a simple reminder not to read too much into things that stick out or short-term changes, since they might not be good predictors of what's going to happen in the long run. Speaking of that, Jack encourages us to have realistic expectations about the future. Here's what he means. For the past few rolling decades, we can see that average annual returns of the S&P 500 have been more than 10%. While I'm happy for all of us who have been able to benefit from it, we need to make sure that we don't automatically assume that it's going to continue forever. Because on the other hand, if we go back a few 10-year rolling periods, then we can see that the average annual returns were all below 10%. I hope every single one of you watching this ends up getting those higher returns, but there's no guarantee because we cannot predict the future. It would be smarter to expect a more realistic, lower average annual return like 7% and be pleasantly surprised to end up with something higher. compared to expecting a higher return and only ending up with something like 7%. The first allows us to retire with enough money, while the second leaves us with not enough money to retire because our high expectations didn't meet reality. I'm going to warn you right now that there's a lot of clowns out there running around the internet basing all of their investing projections on higher average annual returns like 10+%. These people should be arrested and thrown in jail because, in my opinion, this is one of the most irresponsible things that these content creators can do because they clearly do not have your best interest in mind when they spew this type of garbage. If you ever see someone doing this, then consider it an enormous red flag and you should question their integrity. Jack Bogle's next rule captures two essential truths in the investing world that will either make or break your financial future. Time is your friend refers to the miracle of compound interest. It's the idea that a $100 investment at a 7% return will compound into $107 after the first year. Then that $107 at a 7% return will compound into $114. And that $114 will compound into $122. And as time goes on, it grows faster and faster. But not just because you invested that initial $100, because the interest you continue to earn starts earning its own interest. It's like a snowball effect where growth doesn't stop. Well, at least until you decide to stop it, which is why Charlie Munger is known for saying the first rule of compounding is to never interrupt it. The second part of the rule addresses the human tendency to react emotionally by trying to time the market through selling at a market high, then buying back in when the market has bottomed out. As most experienced investors know, this is nearly impossible to do successfully and consistently. Yes, it's possible to get lucky and succeed at this once, heck, even twice, but for someone to confidently think that they can successfully do it multiple times over a lifetime shows how truly brain dead they are. Remember that there's a massive difference between possible and probable. Just ask all of the poor people who play the lottery every single week. Don't mistake luck for skill, because what looks like skill in the short term reveals itself as luck over the long term. But to avoid those impulsive decisions, Bogle has a solution in these next two rules. The first is to buy right and hold tight. He's mainly referring to how your investments are allocated towards stocks and bonds, which will determine how your money will grow. Stock-based funds are designed to grow your money, and bonds are for conserving your money. Mix them both together and you have your asset allocation. I'm not going to go into a lot of detail on this one since I've already made a whole video on it, which I'll link up down in the description below. The main point is to pick an allocation based on your risk tolerance and time horizon. Here's a quick chart from Vanguard showing how different allocations performed during high and low extreme periods of time. So if you're someone who invests in a 100% stock-based fund and can't handle a large drop like that, then you might want to consider investing some money into bonds. If you're someone who isn't sure how much to put into each, then Vanguard has a free questionnaire that you can use to help figure it out. Once you decide that, then hold tight and don't change it until you need to based on personal circumstances and not because of what the stock market is doing in the short term. Bogle's next rule is so straightforward that you'll never have to pay attention to what's going on with the stock market on a day-to-day basis. Too many people waste countless hours gathering information on different stocks and funds to try to figure out which ones to buy, hold on to, and sell. It's like trying to find a needle in a haystack of the thousands of options that exist. So instead of trying to find that needle in a haystack, you're better off just buying the whole darn thing through only purchasing broad-based traditional index funds or their ETF equivalent. By choosing to buy a fund that holds every single stock out there, you only have to worry about one thing. Are publicly traded companies as a whole growing or attempting to grow? Well, I don't know. Is water wet? The whole point of these businesses is to innovate and grow. So the answer is always going to be yes. This investment strategy seeks to benefit from the entire market's growth rather than from the uncertain and inconsistent gains when picking individual funds or stocks. By following his buy the whole haystack rule, you automatically follow this next rule. Beware of fighting the last war. This rule offers a cautionary reminder to investors about the dangers of investing in certain funds based on recent market events, performance, or trends. The principle is deeply rooted in the broader understanding of market cycles and the psychological biases that often lead investors down the wrong path. By focusing too much on recent past performance, investors risk making decisions that aren't aligned with the evolving market environment. And as we all know, things that might have been true 10, 20, or 30 years ago aren't true today. And what's true today won't necessarily be true 10, 20, or 30 years in the future. Trust me, I get why we do it from a psychological perspective. Our brains don't understand how to handle the fact that we're all just flying blind when it comes to knowing what to invest in for the unknown future. To cope with that reality and figure out what to invest in, our brain creates a mental shortcut that looks at past performance to decide which funds to invest for the future. If you follow the previous rule and buy the whole haystack, you'll avoid the trap of chasing past performance. If there's one of Bogle's rules that he's most known for and disliked for, it's this one: minimize costs. Jack was known for not shutting up about lowering fees for investors, which caused his peers in the investing industry to avoid him since it meant less money in their pockets and more money in the pockets of normal investors. It got to the point where they stopped inviting him to certain conferences, but he didn't care because he knew how important it was to keep costs low for investors. Costs eat into your returns. There's no way around it, but they're difficult to wrap your head around since the amount that's charged is shown in the form of a percentage and not a dollar amount. I know 0.5% fee doesn't seem like a lot, but when we convert the amount to dollars, it is mind-blowing. I've broken down the true cost of different fees in many of my videos, so I'm not going to go into a ton of detail. But here's just a small taste of how much different high fees will cost over a 40-year time horizon versus a low-cost fund. Hundreds of thousands of your dollars just disappear because these scumbag funds feel the need to overcharge you. What's even more insidious about this whole thing is that you don't see these fees being withdrawn from your investment account since they're paid out from all of the assets in the fund. If there's one thing that seriously pisses me off more than anything, it's when financial professionals put less educated people into a bunch of high-fee funds without them understanding the true cost. Yeah, no shit, he's really nice to you and sends you a Christmas card every year. You're paying for his kids to go to private school, his $1 million home, that $100,000 car, and his wife's face full of Botox. This is a powerful reminder of the importance of being conscious of costs when investing. Scrutinize and minimize the expenses associated with your investments because the industry will take advantage of you and bleed you dry if you're not careful. But regardless of how you invest, at the end of the day, there is no escaping risk. There are two types of risk: the ones you can control, such as what you invest in, when you invest, and even choosing not to invest, and the ones that are completely out of your control, such as what the Federal Reserve is doing, government regulation, a change in industry conditions, and a change in the overall market conditions. We cannot escape it. This is a feature and not a bug. Heck, even safe money in a savings account is risky since it gets eaten away due to the irresponsible spending of the government. I know some of you are government shills out there. You just love that they spend money. Oh, they're so good at spending money in the right places. No, they're not. The majority of the money that they spend is wasted. All we can do is make informed decisions that balance risk and return, and use diversification and asset allocation as fundamental tools for managing that risk. If you haven't been able to tell by now, Jack was all about choosing simplicity over complexity. Financial institutions promote complexity with investing because the more complex that they make it, the more that you need to pay them to do it for you. They'll say, "Oh, you're not smart enough. This investing stuff is just too complex for the average person. Here, let Daddy Finance handle it for you." But in reality, it's really not difficult at all. Buy low-cost, broad-based traditional index funds or their ETF equivalent, diversify across the world, and choose an asset allocation. Then, all you have to worry about is shoving money into the account. Investing Jack Bogle's way is not difficult, and you don't have to be some math finance whiz to be successful at it. I remember looking at a friend's portfolio and his advisor, no joke, had him in 20 different funds. I laughed because of how complex it was for literally no reason. He could have swapped out those 20 funds with 2 funds and fired that freaking advisor. But remember, complexity is job security for these bozos. They want to make it as complex as possible, so you need them. In a world that just wants to make everything more and more complex, we have to fight for simplicity. The book Essentialism phrases it perfectly. One strategic choice eliminates a universe of other options and maps out a course for the next 5, 10, or even 20 years of your life. Bogle's next rule is perhaps the most symbolic of his overall investment philosophy. Now, I will quote Jack on this one since he said it best. When you consider the previous 9 rules, you realize what they are not about. They are not about magic, not about forecasting the unforecastable, not about betting against long and impossible odds, not about learning some great secret of successful investing. These rules are about elementary math, about fundamental and unarguable principles. Yes, investing is simple, but it is not easy, for it requires discipline, patience, steadfastness, and the most uncommon of all gifts, common sense. This discipline is best summed up by the most important principle of all investment wisdom: stay the course. As much as Jack Bogle loved traditional index funds, he actually hated the ETF version since he thought that they'd cause investors to trade more often than they should. It took him about 14 years to accept them once he realized that some investors like myself can use them responsibly to buy and hold. Check out my top 5 ETFs in this video to your left next. Hit that thumbs up button before you go. Done.